All right. So tonight we are going to talk about, well, primarily taxes. Taxes are huge. There's so many different facets to it. I mean, in personal finance, a lot of times you're talking about how you're going to bring in money and how you're going to keep it. And one of the big items is always going to be taxes. And there's so much in the way of misunderstandings in terms of taxes. Hopefully, you might have been able to watch that video about tax brackets that kind of explains it. I'll go through it again here in a little bit, but man, that is just one area where people absolutely do not get it. And you can talk to somebody who's supposedly working in the field of finance or is perhaps giving you advice and ask them a question or two on tax brackets. And if they don't get it, you need to find a different person because it's really not that complex, but it is probably the most misunderstood concept is all of taxes. There's so many people who just want to, especially as Americans, it's funny, it's a cultural thing. We tend to overpay taxes, in Europe, and especially places like France, they have what they call value added tax. It's a massive sales tax. In Germany, it was 20 some percent, and it was on every time the product changed hands. So it was a value added tax. It went from the wholesaler to the retailer, and anyway, but it wasn't added on at the cash register. It was just included in the price, so it was fairly transparent. But for them, it was a fairly smart way to do it because they could tax the bejesus out of people without them really realizing. Income tax is not such a big deal. Property tax, I pay property tax on the German home I have, and it's not super significant. But there's just so much in the way of corruption. I mean, even Germany, where they're uh, pretty stringent rule followers, I've never had a German contractor come up to me and not ask me the question, do you need a receipt? And if you say I need a receipt, that means that they're going to put the 20% value added tax on it. And if you say I don't need a receipt, that means, oh, okay, cool, we won't charge you that tax. And by the way, half our help is claiming they're on welfare at this point, and they're getting unemployment as well. It's just a different mindset. Anyway, we're already down a rabbit hole and we're barely started. Taxes are an integral part of the economy, and don't get me wrong. Taxes pay for a lot of good things, infrastructure, roads, bridges, schools, stuff like that. But there's also, as things tend to get bigger, things tend to get less efficient. So anyway, don't feel like you know, especially on income tax, don't feel like, well, I should pay my fair share. You are paying your fair share, I guarantee you, especially when you look at all the other taxes. You have what they call sin taxes, alcohol, cigarettes, income, when you're buying fuel, when you're doing your car registration, when you're buying hunting equipment. Anyway, all those things have little user fees sort of included in there that are really nothing else, nothing other than taxes. Another thing too, and this is for people that are really, again, don't get it, where they say, "Oh, I got a huge refund. I'm doing great." No, no, you had way too much money withheld. If you got a big refund, that means essentially you prepay your taxes as you're going through the year. And if you get a big refund at the end of the year, you prepaid typically way too much. And the government's just giving your money back, and they're not paying you interest on the money that they use for the year and the rest of it. Now if you underpay, yeah, they get, they realize that, hey, we're getting ripped off here. Unlike you, they're like, wait a minute, you didn't give us the money until the last minute, and we felt like we were entitled to it earlier in the year, and therefore we're going to start assessing penalties, and we're going to make you do quarterly payments and all the rest of it. But if you want to overpay them, um, they're happy to make you think that you did well and you're getting away with something. Corporations pay income tax on profits. This is one of the things most of you probably won't encounter, but if you're ever setting up a business and you set up a corporation, it can be a bit of a problem. The fact that the corporation pays taxes and then it pays the employees and the employees pay taxes, so it ends up being a double taxation thing. But yeah, corporations, and I want to say medium-sized corporations because the Googles, the Amazons, those folks they've got lawyers, so they're not really paying taxes, not much. But yeah, corporations typically would have to pay taxes on their profits. Homeowners certainly pay property taxes and government services and programs. And um, here we're not paying at the state, but we are definitely paying at the federal and at the local level, certainly. Especially if it's property tax, you live in municipality Anchorage, you were definitely paying for that. And here in the valley, we pay a little bit in terms of sales tax and medium property tax, but there's always taxes. Um, IRS, they do not like to be called that. Obviously, any letters or anything, they're always referred to as the Internal Revenue Service. But taxes paid in several ways. So, in fact, if you've ever been lucky enough to win a lottery or win a big casino jackpot or something like that, they will keep that money right there, right then. So let's say you win $1 million at some casino. They may have a big cardboard check that's $1 million, but you're going to get some lesser amount with the taxes already withheld, and then you'll get what they call a 1099-G. G as in gambling, and 1099s are used for basically contract payments. I pay a number of people with 1099s since I don't want as many employees, and so they have their own business license and they can be hired through contract, and it's more efficient sometimes if you're a small business and you can go that route if you can do it legally. And then estimated quarterly payments. If you're a large taxpayer, they IRS will more or less insist that you make those quarterly payments, especially if you end up owing money. Again, if they owe you money, no, they're not paying that back on a quarterly basis. So this thing all got shifted last year. April 15th is the standard year with COVID. This year was like October or something. Taxes are always paid in arrears, meaning that right now you're going to be working on taxes for 2020. And but the thing that I'll stress here is that tax planning needs to take place throughout the year. You don't wait until April 15th or a few weeks beforehand to start figuring out your taxes. If you do that, there's really nothing you can do. Things are set in stone. Once the end of the year happened, December 31st, any actions you take in terms of buying or selling or doing pretty much anything other than maybe investing in an individual retirement account can't be done once the tax year has expired. The other thing is that this year is kind of crazy because you've got a new administration that has said that they're going to increase taxes, but you really don't know what they're going to be until the following year. So for this year, this April's taxes, we should be pretty much set. But anything you do right now in terms of this year 2021, you're kind of guessing what that tax rate is going to be because it's not set. Social Security, Medicare taxes. Again, more taxes. These are, the reason why your paycheck is not quite what it is because there's a lot of other things that come out of that. And I would still consider them a tax, but because Social Security, although you do may earn some benefits from it, that it's not there's not a thing out there with money set aside specifically for you. No, it's a general fund that tends to get rated, and so probably by the time you all get to retirement age, it's probably going to be what they call means tested, meaning that if you've got a substantial amount of money for retirement, they may just say, yeah, you're not, you don't qualify. It could happen, who knows? But the system is just insolvent. It's essentially a Ponzi scheme type thing where people paying into the system are supporting those currently drawing from the system, which will work, during like a baby boom generation where when they were in the workforce, the baby boomers were, and so you had a lot of people in the workforce and a smaller number of retirees. Now that the baby boomers are retired or near retirement, um, and there's a smaller workforce actually out there, pardon me, giving them Social Security, it becomes insolvent. Plus, they've been hit with a lot of other charges for a lot of other programs. Medicare, you've got Medicare, Medicaid. Medicare is for that's a normal, old age kind of medical process, whereas Medicaid is a welfare process. Um, Other things. So some of these dates, the dates are changing just based upon when the slides were prepared. Some of the data I've got different dates in here. Um, but anyway, it hasn't changed greatly since 2015, 6.2% up to a maximum. So if you're lucky enough, if you have multiple jobs and you're making more than 120, Social Security is not keeping track of that. They'll keep withholding that 6.2, and you have to contact them. So, a lot of people with side hustles or multiple jobs might see that. And Medicare 1.45. And self-employed, yes, they have to pay as well. Personal income taxes. So this is what you're familiar with when you're talking income taxes. What you want to most typically do is use the 1040 form in your earlier stages, or if you're not a high income person and don't mind paying basically more taxes, not taking advantage of deductions and things like that, you can use some of these lesser forms. But once you get to be potentially somebody with some investments, a homeowner, somebody who's going to strive to pay the least amount of taxes that's legally required, it's going to necessitate you going to the more complex form, the 1040. All these things now, and we're going to look at it tonight. Most of these things are, you've got computer software to help you out with that, which is awesome because what happens is you're able to spend more time um, calculating your taxes and running different scenario rather than, having a calculator and doing all these manual calculations and it's just makes for poor record keeping and the rest of it. If you're using something like, TurboTax, TaxCut, so one of the software programs, it makes things quite useful. So this is what they're showing. I apologize, the slide's blurry, but you can see roughly 100% up there and somewhere in the 50% here. But income tax is about that 50% bite, and the rest of it is, the corporations are paying some payroll tax, those other deductions, excise tax, and other tax to make up that whole bit. So um, this is another thing too. And what's screwy about this is that highest 20% of taxpayers pay 88%. But as I've mentioned, as I've alluded to, some of the ultra wealthy really don't pay much in the way at all. You have ways of putting your assets overseas. You have other things that can be done. In fact, let me show you a quick thing. You'll hear, especially in election year, they'll talk about, oh, we're gonna, zap the rich and we're gonna put it up to 90%. That's usually just a typical politician type thing. France has done this. Other places do this. They say, oh, we're gonna soak the rich. We're gonna charge them 75% after they make $1 million. The rich move. They never pay it. These things come out and they just go away. A lot of countries in Europe have tried this. So anytime you hear a politician saying we're gonna get that top 1%, yeah, it hasn't happened yet. It's usually just a political slogan because in essence they really don't want to get that top 1% because that's them and that's their friends, their donors, their you know people. It's whatever. I'm not telling you anything you don't know. It is what it is. This is another thing too, and I don't know why I put this in here, but people too will say, "Oh, we need a $15 minimum wage." Well, realistically, minimum wage ought to be way higher than that. But again, under political pressure, outsourcing manufacturing and bringing in tons of folks who can do unskilled labor. Anyway, it's a supply and demand problem, and there is no demand. So, you know, evil elites, and I'm not going to say it's not a left-right issue. The people, the guy working at Google making 400 grand a year is not going to be a champion. He will say he's a champion for paying $15, but um, again, it's they're going to expect some political allegiance to give you that $15 mandated when in actuality market forces, not the government, should be driving that minimum wage if it had kept place. And there's different ways they measure this. This one's looking at just inflation. Other things will they'll measure it against executive income or the top 1% incomes. If those numbers, again, you've seen it happen here in the COVID situation where the rich get richer and the poor get poorer, and so don't expect the wages to get that high. But yeah, if it seems like, wow, why can't people get by on just a single income anymore? It's because that the ratios of income and expenses are completely out of whack. So if they get $15, it's not going to save the world, and it's it's an artificial imposition. What should actually be driving those wages is a competitive labor market, and so that's driven by other factors, not government mandates. But enough on that. All right. So these were some of the things that this was dated. So this was came out after the Trump thing, and I think a lot of these are going to be rolled back. So what the previous administration had done is they had increased the standard deduction, doubled the tax credit, eliminated some of these deductions. Anyway, it was just kind of a better deal, but a lot of these tax cuts expect them to be rolled back, but we haven't quite seen what's going to happen yet. One of the big aspects that, again, it gets to be a political thing, where many of the blue states have high state income taxes, and so that deduction for state and local taxes was rolled back. Now you can expect that the blue states will get a better deal, and those state and local taxes will be deductible. They'll be reduced off the federal income tax. So if you live in Alaska, it's kind of a raw deal because now it means that you're in essence subsidizing the blue states because they have no incentive to limit the amount they tax their citizens because they deduct that from their federal tax. So anyway, elections have consequences. Filing status. This has to do with, whoops, just rolled forward on me. What you're going to put on the form, and this again is sort of the beauty of using one of the computer programs because certain things, sometimes you're single, but you could be divorced and have a child, which means you could qualify for head of household. Or maybe you're single with no kids, then you don't have any options there at all. But here, if you're married, depending on the tax code, depending on the income disparity between the two earners, if one's making quite a bit of money, the other one's making quite a bit less, um, depending on how the code is written, you may qualify for certain things and may not qualify for others. So, um, for example, let's say you have a child in college and you want to, um, deduct tuition or student loan debt. Well, if you're making more than 70,000 bucks absolute, um, or on the AGI, adjusted gross income, you can't deduct deduct those things. So there will be a higher number for married, but anyway, there's so many moving parts that it's nice to have something like TurboTax or one of these other programs where you can run your taxes both ways and see what works out best. Head of household, so I sort of alluded to that. Head of household means that you have dependents in the home. Otherwise, you would be considered single. you're not married. If you were married, you could claim married, but this is sort of the benefits of being married without being married. But you can only do that while your child is in a qualifying age, and then qualify a widower with the dependent child. So that's just sort of a nice thing to do where you're not, thrown under the bus just because your spouse died. So they give you a year or two to get that sorted out. This is that 1040 form. Now, if you're doing one of the computer programs, which I'll show you here in a second, it's fairly transparent. You won't actually see these forms, and you won't have to go through and, subtract this line from that line. It's all done. And, it spits out the tax calculation at the end. It's just much more user friendly. But all these numbers, all your foreign tax or a lot of these things won't apply, exemptions. Um, anyway, you come down and you get to the amount of tax you owe after you go to a table. But with the software that's available, all those tables and all those other things are built in. So you don't have to actually, ever deal with these forms. Um, but in these items, there's a gross income figure, and that gross income is the highest number. That's all of your income, bonuses, other things that are they talk about a retirement account that comes off the top, like an IRA or 401k, interest earned income, all these different things all go into that total amount, and from that amount, things are reduced, and then we get to a adjusted gross income. But anyway, gross income, dividend income, capital gains. We talked about capital gains before. When you sell something for more than you bought it for, and we use that same definition, short and long, 1 year more or less. Capital gains tax, typically around 15%. Depends on a number of factors, the law, the tax bracket. And you get all those, you add them together, and that's your gross income. So most of us are pretty familiar with that. This is the highest number. And there's not a lot of calculations that are done from a gross income. Typically, what the number you're more interested in is the AGI, the adjusted gross income. Here's a capital gains. So it's different schedules, and it can get very, very complex. But again, there's not much to be gained from knowing the ins and outs of the forms. The skill is to know, the ins and outs of the system. So the forms just are kind of a huge time suck that can typically be avoided. Schedule D. Okay, so adjusted gross income, and sometimes now they're talking about, I guess it's MAGI, modified gross. Anyway, adjusted gross income is the gross income adjusted for contributions to IRAs, alimony payments, not child support, interest paid on student loans if you qualify, if it's below a certain level, and other special circumstances. Now, there's this concept of a standard deduction. When you hear somebody say something's tax deductible, like, because I have to go to work and I have to get uniforms taken care of, or haircuts, or there's so many deductions that come out. Medical expenses that exceed 10% of your income, that you could have just lists and lists and lists of deductions, and you could itemize those. You could calculate those all up. But what the tax code says is they'll say, look, rather than do all that, or even if you do all that, if it doesn't exceed this number, and they'll pick a number like saying, the standard deduction is $17,000, and so you can add up all your deductions, and if they don't, or if they're not greater than $17,000, then you would take the standard deduction. I never take the standard deduction because my deductions always exceed that. And if you're a homeowner, your property tax, your interest paid on your mortgage loan, your home loan, it's all tax deductible. So I exceed that tax deductible level by, double or something, quite a bit more. But anyway, that standard deduction is there, and it's a fixed amount that they just sort of pull out of wherever, and it can be deducted. And if you have nothing else to go by, if you don't have any deductions, if you're just a renter, it may be fortuitous for you to take that standard deduction and call it good. But for most of us, not so much. So this is back in 2015. Standard deduction was 12,006, 9,250. My mortgage interest, and I don't have a huge mortgage, but just to say, if you've got a mortgage, say you're paying, $1,500 a month, well, probably if it's a fairly new mortgage, probably 300 of that is actually paid on the principal, and probably 1,200 of that per month is interest. So $1,200 a month times 12 months, you've already exceeded the standard deduction. So anyway, it's not hard to do, and you'll probably will find yourself not ever taking the standard deduction. Itemized deductions, and this is what I was talking about, where you're going to have lists and lists of stuff. And I went right down in the weeds with, haircuts that might be required, or dry cleaning costs for your uniforms that might be required, or whatever, home office expenses. I mean, this again is something that's nice to have with a tax program where it asks you all these questions, donations to charity, all kinds of things. There's just so many things that are tax deductible. And then state income tax. This is what I was talking about with the Trump administration. They had limited that to $10,000 was the maximum you could deduct. Well, these folks in California, they're paying way more than that in state tax, and so they would always itemize under the Trump administration. They may not have because it was limited to $10,000. All right. Real estate tax, mentioned that. Medical expenses. Keep in mind, you got to be pretty sick here. Hopefully, you will not be deducting this because this is of unreimbursed. If you spend, say, 50, 60 grand because you had some operation, but insurance paid for it, that's a wash. That's not deductible by you. You didn't pay that out of pocket. So if you're making, let's say, $100,000, your medical expenses would have to exceed $10,000 before. So if you had $10,000 worth of expenses, your deduction would be zero. You would have to exceed that before it's even. So anyway, hopefully you don't get yourself in that situation. Charitable gifts. Yep. Not to political parties, though, not to political causes. Certain things are tax deductible. And again, now, the current state of thing, especially with the IRS, if you're making political donations, you're probably better off by doing that by Bitcoin because you don't want people to know who you're giving to because it seems like they're using that information now and again. Be sure to keep receipts and gifts. So I'll show you a little bit. I'll show you some examples later on about tax deductibility and what portion. If you give some organization, they say, "Oh, give to us because it's tax deductible." It's not fully deductible. It's not 100%. It depends on your tax bracket. So I'll show you an example that'll make more sense. I'll pull up TurboTax here in a second. Other expenses, thefts, job expenses. Certain ones are allowed. Job search expenses, which may be something that you all may be encountering. But yeah, I had an old truck one time, and I did not have collision insurance on it because it's kind of expensive, and if it does get crashed, I'm just out. If the accident is your fault, and sure enough, it was. And so yeah, you can deduct things like that. Um, I would certainly do that again though, because I was still money ahead because the insurance that you pay for years and years um, is you just have to do the math to figure out um, you know how long you've had it, and anyway, that's the beauty of driving something that's older with no loan on it. You can lessen the insurance on it, but you're responsible if you have to take the hit. Okay, Schedule A. So again, you don't have to memorize all these forms because this is not. And if you're down in the weeds, actually filling out paper forms, you've more or less have lost sight of the main purpose from a personal finance point of the tax system, and that's paying what is legally required. So there's tax avoidance, which is good sport. That's what you're expected to do. There's loopholes they might call them, or there's um, you know tax benefits that are put in to the tax code, and they're not there by accident. There are certain things that are in the tax code. For example, if you give money to charity, obviously it's tax deductible because that's good for society. If you adopt a kid, those legal expenses are typically tax deductible. So, what people call loopholes a lot of times are not necessarily loopholes, they're incentives. You know, you're just, a rat trying to get the government cheese, and they're trying to guide your life through their little maze, and they want you to be the best person possible, so they're trying to give you little financial incentives. So if you use the tax code to your benefit, you're not a bad person. You're using it as intended. Now, if you flat don't pay your tax, that's called tax evasion, and they will come after you, and the penalties are harsh, as they should be. So what happens is, and this is by design. Let's say you've got some big drug dealer out there, and he's got $1 million. um, the IRS and the federal government, they, don't necessarily want to chase somebody down in the middle of a drug deal. I mean, that could get kind of ugly. Think people get shot and stuff. It's far easier to use the tax code. All they have to do is go to this person who's got $1 million and say, "How'd you get this money?" And if you can't show some, form of legitimate income, W-2s or commissions or something like that, some sort of uh, tax audit trail that would show this being legitimate income, then, the courts are going to assume that that is, from your illicit drug trade. So the penalties for taxes are what some people would consider excessive, but when you look at how it's used in terms of enforcement for getting criminals, the mafia or gangs or whatever like that are usually prosecuted through that sort of system through the tax code, just because it's far easier. You don't need to find the drugs, you don't need to find the weapons and get involved in it. All you have to do is find the person with stacks and stacks of money, and if they can't prove that they got that money legitimately, then they go to jail. And so, yeah, if you cheat on your taxes, even though you're not a drug dealer, you have a big, wad of cash, and you can't show the tax records for where that money came from. Yeah, expect the penalties to be pretty harsh. So, financial planning online TurboTax. So, we'll try and get in there a little bit. Exemptions, we'll talk just quickly about that. Um, Yeah, personal exemption. You see this now. You can claim multiple exemptions through the year to modify the amount of money that's withheld by the government. But at the end of the year, um, you have to, you know, when you actually file your taxes at the end of the year, the numbers have to add up, and both parents say they're divorced, they can't claim multiple exemptions, and people can't be claimed more than once. So one exemption for each filer and each dependent. So both parents can't claim, if they happen to be divorced, can't claim the same dependent. Pardon me, got a cough tonight. Taxable income. So the AGI less the deductions and exemptions, and then you could go into the table and pay that taxes. And the progressive tax system, this is the way, and this works for, just about all of the tax levels with the exception of the ultra wealthy, which usually have means of avoiding the taxes. But um, if you look back at that graph early on, if you're in a very low, poverty line type thing, you're not necessarily paying taxes. You're getting probably money back. You might get a refund even though you didn't even pay into the system. As you go up in the system, not only as a percentage wise does your tax go up, but the actual amount goes up progressively. So, and that's where the tax brackets come into line. And so, um, the vast amount of money is in the upper income brackets, not necessarily the top brackets, but the people in the $200,000 to $300,000 range, or say above $100,000 range. That group in there is paying the majority of the taxes for everybody because they usually don't have the complex tax avoidance systems that the ultra wealthy would have yet. Um, they still have a reasonable amount of income, and that's where the vast numbers of taxpayers are. So that's where they go. Again, politicians will say, well, we should just confiscate the wealth of the ultra rich. The country would survive for a matter of, weeks, months, whatever. There's just not that many of those ultra wealthy people, but there's a whole lot of people in the middle, and that's why they get beat up so badly on taxes, just because there's so many of them. Federal income tax brackets. So as the guy explained, and this was what I was trying to show you. So I'll pick one here. Let's look at a single person, okay? So let's say you're making $100,000, right? So the person's doing all right. They're single. They're making 100 grand. On that first $10,000, the first 10%, they're going to pay. I'm sorry, not. I'm getting not my number screwed up, and it's just by coincidence. They're going to pay 10% tax on that first $9,700. So from $1 to $9,700, they're going to pay 10% tax on that, right? Now, from 9701 up to 39,475, so that next big tranche there, they're going to pay 12% taxes on that amount. They're not going to pay 12% on everything. The first 9,700 is taxed at 10%. This intermediate part's taxed at 12%, and then here we go on up. This next part is from 39,476 up to 84,200. They're paying 22%. And in this case, now this is the Trump system, so these numbers are going to go higher under the Biden administration supposedly. But anyway, they're paying 24% from 84,201 to 160,725. So somebody who doesn't understand tax brackets will go, wait a minute, I'm making $84,200 and I don't want to take that raise because they're going to move me up to $85,000, and that means I'm going to be in a whole different tax bracket. The person does not understand what they're talking about. What would happen if that person's making $85,000? They would have whatever $800 that exceeds this 22%. So $800 of their income would be charged at 24%. The rest of their income would be charged at all those lower rates. So, again, when somebody says, "Oh, I don't want to do that. It's going to move me up in a tax bracket," they don't know what they're talking about. Now, there are, like I mentioned before, about the deductibility of student loan debt or the deductibility of certain government programs. Sometimes those have absolute dollar limits. And so, you could be making, let's say, and the student loan thing I think is about 70 grand. If you're making less than $70,000, your student loan interest is tax deductible. If it exceeds that, it's not tax deductible. Well, number one, I'm not just going to be throwing around numbers. I'm going to look in the regs and in the regulations and figure out exactly what that number is, and I'm going to get below it. I'm going to, if I can at all, and again, you could, I'd give some money to charity, I'd do whatever to get my numbers adjusted below that level so that I qualify for that. And guess what? If you waited till April 15th to do your taxes or sometime after the first year, you can't make those kinds of adjustments. So, you can start running trial runs of your taxes on one of those programs. And I'm not shilling for these guys because you're not paying these guys. You do not pay TurboTax or any one of these guys until you actually file the taxes. So even if you say I'm old school, I'm going to do it by hand, or I'm going to do it, on some standalone computer program, or I'm going to take it to, Liberty Tax or somebody else, there's no penalty. There's nothing working against you by not running it through TurboTax first. And again, before you go to Liberty or one of those guys, keep in mind I've been in places where they're hiring people, and just like I generally work on my cars myself because I don't trust a lot of the mechanics because they don't have a great pool to draw from. A lot of those people preparing taxes are they're you know may or may not be that good. I had some friends I know this one guy he did it weekends during tax seasons, and he was as dumb as a rock, and I wouldn't let him anywhere near my taxes. So there's not a whole lot of people who can just take on a part-time job during tax season. I'm sure there's some qualified people, and I actually have there's a couple people who work on my taxes now, and oh my God, I mean they're good. So I calculate the numbers myself, but their numbers and they stand behind them are quite a bit lower. So um, I'm humble enough to admit that whatever it all works. Um, what were the differences? Oh, that was 2019. Here's 2020. So again, um, these are going to be the ones for this year. So um, this should be set, although we've got a new administration. So will they change them? Could, but typically not. Usually, I think it's going to be next year. Any actions you're taking right now here in 2021, um, the tax year 2020 is already closed out. Determine your tax liability. So anyway, you can go into one of these tax schedules, pages and pages, look up your income, and it'll tell you what you owe. Or, something like TurboTax will just calculate it out for you. Tax credits. Tax credits, totally different thing than tax deductible. Tax deductible is kind of a nice to have. It means that amount of income, let's say you give $1,000 to charity and it's tax deductible. Well, it means you can adjust your income. Let's say you're making 100 grand, you give $1,000 to charity, you can reduce your income by $1,000. So it takes your income that's reported to the IRS down to 99,000, and so now you're just paying taxes on 99,000. And assuming you're in that 24, 28% tax bracket, the benefit to you is somewhere around 240 to 20 or 280, 24, 28% of $1,000. So it's nice, but it's not a one for one. Tax credit is a one for one. Tax credit is and yeah, generally for children. Sometimes you'll see them for solar things. Sometimes there'll be some disaster relief. Anyway, tax credits and tax deductible, totally different things. Credits are wonderful. I mean, it's a one-to-one reduction. If let's say you do all your math and you owe the government $10,000 worth of income tax. If you have $1,000 tax credit, you only owe the government 9,000. So it's much more powerful than a tax deduction. Um, Tax credit, yeah. Keep in mind there's income limits. 529s, we'll talk about this. So, I mean, as long as we're here right now, this is one of the things. And so this is kind of where personal finance and tax planning, there's lots of overlaps. Let's say you're writing your term paper and you say, I'm going to save up whatever amount of money for my children's, future college education and whatever, and you get a B or a C on your paper, and you wonder why. It's because, well, what happens if you just put that money into just a general investment because you're going to save for your kids' college, if unless you put it in a special fund, like say a 529 that's designated for college, it's going to be taxable. So you're going to, let's say you did well, and there's a $100,000 of an interest that account accrued. Well, if it's under not some sort of tax preferred plan, you're going to have to pay tax on that. So, whereas if you would have had it under the 529, you would have been able to give your child $100,000. Since you didn't do that, your child only gets 85,000 because 15% of it had to go for paying tax unnecessarily. Under a 529 plan, all that money that was used for education is tax free. So anyway, and it doesn't have an income limit. So way off in the future, when you're making big money and your child's now going to college, it still doesn't affect it. So different states have different plans. You'll see different things, but 529s are a big one. And these are not a mystery. You don't have to really search for this. If you went right now on one of the big websites, Fidelity, Vanguard, something like that, that you'll probably go to when you're preparing your term paper, and you look at something about saving for my child's education, they're going to talk about 529 plans. I guarantee it. Or whatever other types of things. There's medical savings. There's other things that are all sorts of incentives that the government kind of again decides what's good and what's bad. If it's for hookers and blow, it's not tax deductible. If it's for college, it's there's going to probably be a plan that's going to help you out. Earn income. So this applies to lower income people, but you'll see this calculation always done when you're filling out your taxes. Child care, adoptions, again, other credits. So if it's a credit, you definitely want to pursue it, but there's not very many credits out there. And again, they take you back to something like TurboTax. Okay, so what I'm going to do here is I'm going to show you just a couple things. I'm sure this thing is timed out, which it always does. So this is not my real account, right? So TurboTax doesn't care. I've used it for many years now, but I'm going to sign on to it. And the neat thing about it is it keeps the record. Yep. So that's just my what do you call it, email. So I guess I've been using this thing for 7 years. I actually have one that I do use, but what I want to do here is I just want to show you, some examples. Now, there's going to be all sorts of nag strains, and they're going to try and, upsell you to all sorts of products, but everything is start for free, right? And some of these, especially, they want to build some brand loyalty. So if you don't have a complex return, they'll let you do it for free right now, all the way through filing. Any of these other ones are going to try and hit you with some sort of charge at a certain point. Um, I'm just going to go through and there's going to be a series of nag screens. The good thing about this too is it's fairly efficient. And again, I'm not a salesman for TurboTax. Any of these programs do this, but they keep a lot of your address, employer, all that kind of information. If it doesn't change from year to year, it's kind of helpful because again, you spend more time working on your items. So yeah, my name's UAA. I was born in '85, maybe. Anyway, all kinds of different forms, but it's kind of pre-populating thing, and it's just again they're going to try and upsell you. Sure, yeah, uh-huh. I'm not married. Okay, continue. I guess it wants a date in here. Ain't. Oh, it knows the date. Why doesn't it just fill it in for me? Oh well. 01/4. Okay, so just some legal stuff that's getting out of the way. But again, this is just a BS profile. Um, Again, all this information will be pre-printed. Tell them I'm single. No. Anyway, what I'm trying to do is I'm trying to get to some of these places. I don't care. No. Make the bad man go away. They actually say that they've got some sort of audit service or other programs. I don't do this. Let's get started. This is what we're after. Gambling, like I say, if you won money gambling, the IRS knows about it. There was a 1099-G filled out by the casino, by the lottery, by the whoever. Um, Capital gains or losses carried over. I'm just, for simplicity, I'm going to say no. Did you sell any property? Anyway, so a lot of these questions, it does kind of make things easier because it's things that you whatever, just ask some of the questions. Okay, so for simplicity here, I told them, look, I'm making 100 grand just so I've got some reasonable numbers, and I didn't put anything in here. What I want to do is I want to show you some of the things we were talking about in terms of tax deductibility, and it's knows that home interest rate, mortgage interest rate is going to be tax deductible. Wells Fargo is the bank that I put in here, which is funny because most people do end up with Wells Fargo. You can do business with whoever you want in town, in terms of mortgage brokers, but they typically sell off the loans to either Wells Fargo or mortgage or Freedom Mortgage. So um, regardless, you're probably going to end up with them. So that's not unrealistic. And I gave some money to Good Cause, just some mythical charity. Again, just to show you the effect on taxes. Um, Car registration fees, certain proportions of those are tax deductible. Estimated tax payments, no. Sometimes you have to if you're in the penalty box for the IRS. Energy saving improvements. Again, it may be getting up close to the end of the year and you're like, wait a minute, I was thinking about doing that. Maybe this credit's going to go away next year. So again, if you waited till after the tax year is ended, you're kind of screwed. If you looked at this in December, you said, wait a minute, before the tax year ends, I want to jump in and try and do something like that. Qualified retirement plan. most people will put money in a 401k or an IRA. So, anyways, just asking you questions. Health savings account, medical savings account. I did not. So again, this isn't really what I'm trying to show you, but what I am trying to show you is up in the corner here is going to be income that is your income that is due to you, income tax, either refund or deduction that's due to you, and this number will change based upon your inputs. Okay, so I'm saying that I paid, in this example, 12. I'm gonna, I guess, to enter numbers, I gotta put some numbers in there. No, it would actually do an auto import for you, but no, I'm not doing that. I'm gonna type it in myself, which it already auto populated. Nope. Okay, so typically it would already have a tax amount in here. So let me check the W-2 real quick before we go any further. Um, Self-employment income and expenses, 1099. Where are my W-2s? Hmm. We'll give this another potato. All right, so I had to pause it there for a second because I couldn't figure out why we weren't getting this number up. Turned out that it didn't accept the W-2 number I went with before. But anyway, now that's resolved. So I've got $100,000 in income, and I actually put that um, I had withheld some in terms of taxes. Let me see the numbers I put in here. I put that $15,000 had already been withheld out of my taxes. Okay. I just put in a bunch of bogus numbers. 6,200 for Social Security. I just put in some numbers just to give it something to work with to keep it happy. So um, right now this column up here says based upon the 15,000 that's already been withheld, I still owe another $110,000 or another $110. Okay. So that number is going to change as I go along. So a couple things I wanted to show you. One thing is, let's say you're buying a house and you say, well, I want to buy a house because it's a great deal because, the interest on mortgages is tax deductible and the property tax is tax deductible. So I'm told it's a good deal. But I mean, do you have anything tangible in terms of numbers, in terms of what that's going to be? Well, you have the ability to put those numbers in here. You can find out roughly what the interest and that's going to be paid over the course of a year. Let's say in this case it's going to be $12,000. So um, obviously, if you're paying rent to a landlord, he's deducting the interest he's paying. He's doing it on a business deduction, not like a homeowner. But anyway, if you're paying rent, you're not getting any benefit from that at all. If you're the homeowner, you're um, paying the mortgage, and that money is deductible. Likewise, your property taxes, let's say, oh, I don't know, 8 grand, maybe. So about $20,000 worth of interest. So by owning a home, a lot of moving parts here, but just based upon the interest deductibility and the tax deductibility, your taxes went down. You would be getting a refund of 1604 at this point. So you can back those numbers out. Just the same, you can go back and you can do this, married filing singly, married filing jointly. You can run the numbers in different ways. And then also I talked about something being tax deductible, right? And it's, here I've just put in some BS charity. Let's say we're going to give these folks some money. Again, different ways, and this stuff will hopefully keep you out of trouble. But let's say I'm giving them a bunch of furniture. Um, they have some service that they work with that might work that out. Or if you're giving stuff to a thrift store, what have you, you might ask for a receipt. But again, the value that's put on it is up to you. You want to be honest here, but the only important thing here is that it was in last tax year, right? Or else the computer's going to say that's not eligible. So what is that, January 2nd? Let's say I gave him some household items for simplicity. Whatever. This is kind of for your records. And if you don't go nuts with these numbers, as long as you make a good faith effort, it's going to be between you and the IRS. And it's probably going to happen a year down the line. But if you have a receipt and if you can, know what the items were, you're going to be, you know, in good shape. So let's say, yeah, I gave him a lot of stuff. I gave him $1,000 worth of stuff. Okay, so it's tax deductible, and um, but it's not a tax credit. So when somebody says, "Give us some money," it's tax deductible. You give them $1,000, your taxes do not go down by 1,000. Now we talked about tax brackets and all that. So out of $1,000, and based upon the income I gave them, I believe we're probably in around the 24% tax bracket. So I would bet that this amount is going to go down by about 240 bucks. Let's see what happens. Or go up. It's going to increase because I'm already getting a refund. So it's going to go to around 1844 if I'm right, 1824. So again, a little magic in there, but you get the idea. It's not a one for one thing. And then also, if you're going through and you're doing something like, I sent my daughter to out of state college, and so that's why I keep coming back to this. I thought a big portion of it was going to be tax deductible, and I found out no, it's not. And rather than, I wasn't going to yank her out of school, but I would have liked to have known that information earlier rather than later. Um, Anyway, sales tax information, if you're in a place there's lots of little things that you may not think of that these programs may remind you of, and they've got different programs. So I'm kind of a big fan of these programs if you haven't noticed. But this is much more useful time for you because a lot of these things, even though they're bogus numbers, the forms, the address, the dependents, all those things are already calculated. It already kind of has a record of banks that I typically deal with. And it's a pretty good reminder of, see, all tax breaks, and tax deductions, COVID-19 things that are, unique. And so even if you're having somebody else prepare your taxes, I think you're kind of short-sighted if you don't run through because it's like anything else. If it's for you, you're going to take a pretty you know nobody takes care of your stuff like you do, and you're going to learn a little something along the way, and you're going to maybe change your not your spending habits, but your life a little bit to realize what's useful, what's not. And again, when you have something stolen, when you have something like that, I mean, to know that that's tax deductible, to tax preparation fees, the silly $70 you might spend on this program if you actually filed with them, that's deductible. Moving expenses, there's limitations on things like that. Disasters, what qualifies, what doesn't. When a politician says, "Oh, it's been designated a federal disaster zone," that has some legal implications. Um, Property loss. So anyway, there's a lot to taxes. We'll kind of revisit it. Um, Let me see if there's anything else I want to do here. The When I talk about 401k type stuff, um, it's sort of transparent by the time you get to a program like this. What would happen is your W-2 would reflect that the 401k, and again, 401ks, IRAs, those are tax deferred products. So you don't put in a bunch of details with your 401k in something like TurboTax or when you're filing your taxes. That's already calculated when you enter your W-2 information. So what would happen is if I was, a good boy here and I put in, 20,000 bucks into my IRA, my income would only appear as 80,000 on my W-2. Now again, this is not 8,000, 80,000. It's tax deferred, so it's kind of a gut check. You're going to pay taxes on this sometime in the future, so are taxes going to be higher then? Probably. But you can see right now I'm getting a refund of 1824. I just lessened my income by 20 grand. And when I hit continue, yeah, the numbers changed by a lot. So let's say, I'm not going to contribute to my 401k. I need every dime to live on. Well, guess what? You don't get every dime because that higher tax bracket, as you know, that's where they take the highest percentage. So in your attempt to keep every bit of that extra $20,000, you lost, in this case, 24% of it in taxes right then. Compared to me in this example, I reduced my income, Medicare taxes, that's a different thing. I reduced my income down to 80,000, and by that, I changed it. All right. Anyway, you could spend hours in here messing with things, but it's useful. It's current on the tax code. It's updated. It keeps your records, and I think it focuses your tax time. It's a painful, time every year having to do your taxes, but at least your time spent on something like this is more useful because a lot of the drudgery, the finding forms and looking up details, are can be avoided. And I would also argue that they're probably a little bit more accurate than going through. But I do like the sort of reminder function. All right, enough for tonight. We will talk more about this on another day, but taxes are a huge, huge part to personal finance.